Settling tax balances can feel overwhelming, but the IRS Offer and Compromise program offers a potential solution. Under this program, taxpayers can resolve their outstanding liabilities for less than the full amount owed. Paying off tax balances through an OIC involves important steps: determining eligibility, completing the application process with required forms and financial documentation, and selecting a payment option. Let's walk you through each of these steps to help you better understand how the process works and whether it's the right solution for your tax situation. The IRS Offer and Compromise program is designed to help taxpayers who cannot pay their full tax debt due to financial hardship. It allows them to settle for less than what they owe, as long as they meet specific criteria. Eligibility is determined based on your financial condition, including your income, expenses, ability to pay, and asset equity. If you qualify, you can begin the application process, which involves submitting detailed financial information and specific IRS forms. Once your offer is accepted, you'll choose from payment options, such as a lump sum or periodic payment plan. It's important to understand, however, that this program is not for everyone. Applications are thoroughly reviewed, and approval may take time. Additionally, you must stay compliant with future tax obligations. Understanding the details of the IRS Offer and Compromise can help you decide if it's the right choice for resolving your tax debt. Now, let's explore the types of offers available through this program. When considering offers and compromise, it's important to understand that there are different types, each designed to address specific circumstances. These options allow taxpayers to resolve their tax obligations over a reasonable period of time, such as through monthly payments. By choosing the right type of offer, you can avoid long-term financial strain while satisfying the IRS's requirements. The doubt as to liability option is for taxpayers who truly believe their tax liability has been incorrectly assessed. If you believe your outstanding tax liability is based on a mistake or misunderstanding, this option allows you to dispute it using Form 656. To use this section effectively, you'll need to provide evidence and documentation to support your claim. This may include refund claims, financial records, or prior correspondence with the IRS. They will evaluate your submission and suspend collection activity while they review the case. If you discover additional outstanding liabilities during this process, you'll need to amend your submission immediately. This ensures that all aspects of your tax liability are properly addressed and increases your chances of a favorable outcome. This option is reserved for individual taxpayers who owe the IRS but can prove that full payment would cause significant financial hardship by doing so, even if they are technically able to pay. The IRS considers effective tax administration by reviewing a taxpayer's special circumstances, such as age, health, or income limitations, and how these factors affect their ability to meet their federal tax return obligations. Special circumstances, such as ongoing medical expenses or other financial burdens, are considered in the review request. This approach helps ensure that the IRS resolution is consistent with administrative rules while prioritizing fairness and preventing undue hardship, making it a valuable part of the offer and compromise process. Doubt as to collectability, on the other hand, arises when there's uncertainty as to whether the IRS can collect the full amount of the tax debt within the statutorily allowed collection period. This type of offer and compromise is intended for taxpayers whose financial circumstances indicate that they don't have the means to fully satisfy their outstanding obligations. In assessing collectability, the IRS considers several key factors: the debtor's financial situation, including income, expenses, and asset equity; historical payment patterns, which indicate whether payments have been made consistently in the past; market conditions that may affect the taxpayer's ability to generate income or liquidate assets; the taxpayer's reasonable collection potential, or RCP, which is the IRS's estimate of how much can realistically be recovered; other factors, such as unavoidable medical expenses, dependents, or unexpected life events that affect the collection process. To address doubts about collectability, taxpayers should provide clear and accurate documentation of their financial situation. This evidence helps support their inability to pay in full, which can strengthen their case during the collection actions process. Qualifying for an IRS offer and compromise can provide significant relief for eligible taxpayers, but the process has strict requirements to ensure it's only granted to those who truly need it. First, all tax returns must be filed and current. The IRS won't consider your application if you have missing or incomplete filings. Likewise, any bankruptcy petition must be resolved before you can proceed. taxpayers in active bankruptcy proceedings are not eligible for an offer. Next, your individual income tax debt must meet the IRS threshold for an offer in compromise, which is usually based on your inability to pay the full amount owed within the collection period. If you owe taxes as a business owner, make sure all federal tax deposits are current. Additionally, taxpayers must have made any required estimated tax payments for the current tax year. For employers, payroll deposits should also be up to date. And don't forget, if you've received a tax filing extension, the IRS expects you to comply with that deadline before applying. Meeting these criteria is critical as it demonstrates your commitment to compliance while seeking relief. If you're unsure of your status, consulting with a tax professional can help clarify your eligibility and guide you through the process. Calculating your offer in compromise amount is key in the application process. Calculate your offer amount using Form 433A as your reference. This form helps figure the minimum amount the IRS may accept based on your reasonable collection potential. It considers your income, assets, and allowable expenses. If you qualify for periodic payments or installment payments, these will also be factored into your total. Now, if you can't pay the calculated minimum because of special circumstances, you can propose a lower amount. Be sure to explain these circumstances thoroughly on Form 656 and provide supporting documentation to strengthen your case. It's important to be specific and provide all the necessary information to convince the IRS to accept your offer. If the IRS reviews your offer and determines that it's insufficient and no special circumstances apply, you'll have the opportunity to adjust your offer to meet their requirements. This flexibility allows taxpayers to work toward a resolution, even if their initial calculation falls short. Understanding the payment requirements, how to properly calculate your offer, and how to accurately complete your forms can make a significant difference in the success of your claim. Speaking of forms, when applying for an offer in compromise, having the right ones will help ensure that your application is complete and accurate. Following the IRS background information provided, you will need Form 656, the official request form used to submit your offer in compromise. This form outlines the terms of your offer and provides space to explain your circumstances. It's central to the application process. For individual taxpayers, a Form 433A, OIC, to provide detailed information about your financial situation, including income, expenses, assets, and liabilities. If you represent a business, you'll use Form 433B, OIC, to document similar financial details tailored to a business context. It's important to attach all required documentation to support your claims. This may include bank statements, pay stubs, or expense receipts. Incomplete submissions, missing documents, or inaccuracies can delay review or lead to rejection. Don't forget the application fee, which is mandatory unless you qualify for a financial hardship waiver. Taxpayers who meet the low-income certification guidelines may be exempt from this fee and the initial payment. The IRS provides a structured process to follow regarding the payment of your offer in compromise. Let's break it down step by step. First, you'll need to submit the request forms along with all required documentation, including the current application fee and, if required, an initial payment. The forms for individuals and businesses have slightly different requirements. Individual taxpayers must complete Form 433A, OIC, while businesses must file Form 433B, OIC. Both forms need to be joined with Form 656, which outlines the details of your offer. Review the IRS instructions to confirm that you've included all the necessary information. You have two main options for making payments: a lump sum payment, where you pay the full offer or at least 20% upfront, with the application, or a periodic payment option, which allows you to spread your payments over time while continuing to pay during the review process. To send your forms and payments, use the IRS-designated mailing address provided in the Form 656 instructions, which varies depending on your location. Finally, keep track of your selected installment payment agreement to ensure compliance with the periodic payment option requirements. By following these step-by-step instructions, you'll ensure that your offer in compromise is accurate and complete, moving you closer to resolving your tax obligations. Navigating the offer in compromise process can feel overwhelming, but with the right approach, you can increase your chances of success. First and foremost, it's important to understand the eligibility requirements to know how the IRS will evaluate your case. The IRS considers several factors, such as your ability to pay, equity and assets, current and future income, and necessary living expenses. They also evaluate the potential for exceptional circumstances. For example, if your income might decrease due to retirement or health issues. Understanding these requirements also means recognizing that the IRS will weigh what's in the state's best interest. That means they'll consider whether accepting your offer will ultimately benefit the government, either by recovering some of the taxes you owe or by closing your case efficiently. Keeping this in mind can help you tailor your offer and compromise to show how your offer aligns with these interests. Before submitting your offer and compromise application, gather all the necessary documentation and make sure every detail is accurate. Using tools such as the Offer and Compromise Pre-Qualifier tool can help you determine if you meet the initial criteria. Also, stay informed about the collection process. Even if you apply, the IRS may still pursue collection actions unless you meet certain requirements. For an optimal outcome, consulting with a tax professional can guide you through the complexities of the process, provide valuable insight into your financial situation, verify that your application is complete, and help you make a stronger case for an offer and compromise. Remember, this is a collaborative process. Presenting a reasonable and well-supported offer and compromise shows your commitment to resolving your tax issues in a way that works for both you and the IRS. We hope this video has been helpful. Make sure to subscribe to our channel as we continue to delve deeper into important tax-related subjects.